Christyan, let's talk a little bit about what is happening here. Let's start off with OPEC and figure out what it is going to do, and then we'll kind of work our way through this story. What should OPEC do? What will OPEC Plus do?
Hey guys, so a couple of weeks ago we talked about up to 1 million barrels of a cut, but if you think about it, I mean, Russia could probably cut 500,000 barrels just through seasonality and declines, and OPEC started producing by 500. So really an actual cut would be an additional 500. So that million, you've already got 500 as a base case, and an additional 500 in order to put protect a floor around $80. But I would add that this is not just about cutting into tightening the market, but actually a very sort of emergence of a spread between what the US would like to see, oil prices closer to 80 and sub 80, and what OPEC would like to see, an oil price well above 100.
Where do you see the greatest pricing to risk come from? Is it to the downside or the upside at this point? If you listen to what Jeff Currie had said a little earlier, I'm wondering how long that overhang actually lasts for, given that some of it is not tied to what you're seeing in the macro and the supply demand dynamics.
Yeah, I mean, you're absolutely right, Shanali. So there are absolute headwinds that we've got to respect: fiscal unwind, China lockdowns, and the currency. It's like getting in front of a bus, trying to go long with very little open interest, so you're record low liquidity. So all these things could skew prices in the short term to the downside, but what OPEC will do, I think, next week will arrest that decline. And then when you start to see China reopening, the dollar clearly is going to have to stabilize, and ultimately inventories continue to fall. What we could end up seeing is a bit of a boomerang effect where oil prices rally aggressively well above 100, because now you're coming off a lower cut. The question I have is, as we see that happen, what does OPEC do? Our view is that there's a clear probability, there's a high probability that they will actually continue to cut, even into a tightening market, which is where we have to think about the risk of a potential price war, but this time to the upside, between OPEC and what they are looking versus the US and other consumers.
Let's talk about a real war. The German finance minister earlier on today was talking about an energy war. This follows what we've just seen in the Baltic Sea, Christyan, with the detonations we now think on the Nord Stream 1 and Nord Stream 2 pipelines. If we extrapolate that and think about how an energy war may be fought and infrastructure being potentially exposed, do you think the market is correctly pricing that risk right now? How do you price that risk?
Absolutely not. I think there's a degree of complacency in terms of the geopolitical risk premia. If you think about it, Guy, I mean, up to now, we've had a bit of to call it a man-made energy crunch, right? The actual supply has been inflicted by Russia, and that's what we're seeing. We're yet to embark on a real energy crisis where you have structural declines in production, which is something that we've been talking about through our super cycle thesis since spring of 2020. So you've got that emerging through 23, 24 as production comes off, particularly oil supply from the majors. At the same time, you have this potential interference and increasing interference in pipeline infrastructure happening. And so when you think about those two things combined, we are absolutely, I don't think we're pricing anywhere near the levels of geopolitical interference on one plane and a real tightness on the other.
Play this into some of the other broader fears we're seeing. You know, I think back to last week, your CEO, Jamie Dimon, had said oil at 150 would mean a global recession. So do you believe that we get there anytime soon, given all the warning signs that you're drawing out right now? How soon do we get there, and what does it really mean? Yeah, we called for $150 oil last November on the back of a very limited spare capacity. I actually remember being on the show talking about this, and that we are going into an historic low degree of spare capacity globally, and not least OPEC. And that will see a risk premium emerge as a result of that limited headroom. In history, you've always got a $20, $30 risk premium. The key here is how quickly we get there, Shanali. Jamie's absolutely right. If we get there within weeks, that's a price shock the world cannot take. If we get there through a gradual repricing in the context of the gas price equivalent of oil the oil price equivalent of gas is around $300. Coal is $400. So oil is actually quite cheap relative to history, relative to all fuels. And so as we see a repricing of oil, if it's gradual, we think the economy can take it, but absolutely it would need time to get there. And I think that's a scenario that we've painted for next year. In the meantime, we're looking to see over $100 oil by the end of the year.
What's the best way of playing this? If I held, for instance, here in London, Shell or BP, or on the continent, Total, etc., am I a buyer or a seller, do you think, of those stocks?
In actual fact, Guy, I think the best way to play this energy market is through the equities, and because what we're seeing essentially is a high grading of the back end of the curve. The back end of the curve, it's all over the place, but it's continuing to rise. And if that means that the cash flows these companies can make only gets better. So energy equities, I'd say Shell, Total, are the proxies for more cash flow coming from a higher back end on a more return of cash flow, and more jewels, which is something we've talked about, on lower carbon. I think as investors start to think about this sector and try to form a sort of hybrid mandate of ESG and energy, particularly into a crisis, they're going to be looking at this sector as a rate of change from what bad co to good co. And in that scenario, this sector actually gives investors who have traditionally had a very strong ESG mandate exposure, because they're growing energy, but they're also lowering their carbon at the same time. So it's a great investment case for generalists that wouldn't have been the case, let's say, 12 to 18 months ago.
We had been talking so much about a lot of these geopolitical issues as well as just kind of the pricing dynamics here, but the reality is, to the extent that you see that March past $100 a barrel, then wouldn't that equate to a lot of demand pressure as well? So at what point does a recession become a really deflationary force here for the energy industry?
Yeah, it's interesting, because I mean, we tend to think about demand destruction. I think that's been hyped a lot in the context of higher energy prices. We're in discovery, if I'm going to be honest, Shanali. We don't know what price we can see serious demand destruction. But think of it this way: if we're in a world that's short energy, short joules, and you have oil, you're going to your customer, I've got good news and bad news. The good news is I've got oil. The bad news, you're going to have to pay a lot more for it. If there's a shortage, the answer will be just get me some. And that repricing, that demand destruction or elasticity, is something we have to see emerge, because if we are short energy, then ultimately the consumer's going to take it, but it will end up subsidizing other economies. And I think we're still okay at 110, 120. I don't think that tips us into recession. But ultimately, the warning shot to the industry is invest, 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 because if you don't, you're going to see massive price shocks to the upside, because you have these deficits that we can't control. And that's why we're not in an energy crisis yet.